More and more people are wondering if their money is truly safe within the US banking system. News are everywhere about the latest financial scandal, and the topic is one of the most searched online. In the next video, we're going to review what happened in 15 minutes, covering basic financial information to help you digest what many see as a very complex subject, from basic banking understanding to how the Silicon Valley Bank actually operated, what caused the panic, and what you could do to protect your wealth and your legacy. Just a few weeks ago, Silicon Valley Bank was viewed as one of the most respected players in the banking industry, with thousands of venture capital-backed startups as clients. Fast forward to Friday, March the 10th, and banking regulators started to close down their operations. How did this happen? What illicit business and gambling activities were they involved in? How can a successful bank from Forbes Financial All-Stars list collapse overnight? Most Wall Street analysts saw this bank stock as one of the most positive and optimistic stocks in the banking sector. So even Jim Cramer from CNBC's Mad Money recently recommended Silicon Valley Bank stock as one of the top picks. So how could everybody be so wrong? Was this planned out or did it just happen? Let's start with how a traditional bank is supposed to work. Banks became a new business model during the 11th century in Italy to make life simpler to help merchants trade their goods. Most of these bank activities took place outdoors, in the benches or bancas in Pisa, Italy. So that is where the word comes from, bank. People keep their money in the banks, and in return, they receive a small amount of interest. The banks lend the money out in the form of loans in order to receive interest income that pays the interest expense that banks are supposed to pay to their depositors. In other words, banks take funds from you, from your savings account, and then they use that money for things our society uses, such as loans for new businesses, credit cards, currency exchanges, auto loans, and other long-term financial products. Now, modern banks, on the other hand, are in the business of short-term gains that carry more risk. Modern banks are in the business of high-risk management with complex financial products. Most of these complex financial products became very popular in the early 2000s, creating a high-risk international web that tangled the whole world with toxic assets. These financial instruments became very profitable products for the banks that were collateralized with high-risk mortgages, but most of them went upside down when the interest rates started going up during the early 2008 crisis. Now, the Silicon Valley Bank thrived during the low interest rate era, attracting more than 50% of all venture capital supported companies in the United States. Venture capital funds or private equity funds are investment funds that invested billions of dollars funding new companies. These investments from the venture capital partners or equity funds were given to the emerging companies in the form of equity, meaning in exchange of a piece of the pie. These were not loans or debt that had fixed monthly payments because these new emerging companies did not have a proven business model. They had just opened their doors, so they had to give up a piece of the pie to the equity partners in exchange for the risk. Now, this is where it all starts. These new emerging companies started receiving millions and millions of dollars, and Silicon Valley Bank became the go-to bank that received the majority of these deposits. Now, most people would think receiving all these deposits is a good thing for a bank, but not always. These new companies that were formed that were receiving these large deposits were not that ideal client base for a bank. These were brand new companies that did not qualify for a regular banking product that usually make money for the bank. See, a bank is supposed to invest your deposits in order to generate a return that could then be used to pay the depositors interest for parking the money in the bank account. The client base for the bank could not qualify for loans that allowed the banks to earn interest income and then turn that interest income to pay interest to the account holders. Now, there were billions of dollars sitting at Silicon Bank's bank accounts, so they had to put the money to work. During the pandemic, interest rates dropped to the lowest levels, so venture capital raised a record of $330 billion, which is double the amount seen in 2020. Matt Levine from Bloomberg sums it all up with one sentence. When rates are low everywhere, $1 in 20 years is about as good as $1 today. So a startup business that will make millions in the future, even though it won't make money for the next decade or so, is usually the best bet when rates are low. Now, when rates are high, $1 today is better than $1 tomorrow, so investors will want cash flow. When rates are low for a long time and suddenly become high, all of that money that emerging businesses were getting from private equity is suddenly cut off. In other words, interest rates were low, investors could wait for cash flow to come in a decade or two, then interest rates go high, and all of a sudden now investors want cash flow today. So this is what happened. Rates were low during the pandemic, account holders, but then rates go up and investors want cash flow. Silicon Valley Bank did exactly that. They invested $80 billion in bonds because it was the safest bet to receive money and their principal several years later. Now, rates went up, bond prices declined, and Silicon Valley Bank started taking major losses on their long-term bond holdings. As interest rates start to go up, the value of long-term bonds comes down. So all the bond investments that Silicon Valley Bank had to make because of all those deposits, they are worth less and less today. Remember the inverse relationship between value of bonds and rates? Well, bond values came down as rates started to go up. So the bank's balance sheet now reflected unrealized losses because those assets were not worth $100 anymore. Now they're worth $34. So how did the bank run start? With the credit rating downgrade word out, private equity groups started asking their clients or portfolio companies to move their company out of the Silicon Valley Bank. That same capital that these private equity groups had put into these companies and that was sitting at the Silicon Valley Bank's accounts. These private equity groups were concerned about the bank's solvency to cover the large number of bonds that they needed to liquidate. Remember, every bank is exposed to these type of runs. Fractional banking has allowed banks to turn $1 of deposits into $10 of money for consumers and businesses to borrow. So all banks would have the same situation. And the FDIC, which is the depositors insurance, only has to cover up to $250,000 of deposited funds. In this situation, the FDIC and the government stepped in and decided to bail out everybody, including those that had more than $250,000. And now another specialty bank called Silvergate Bank. With similar characteristics, providing services for corporates in the cryptocurrency markets, those businesses also had large deposits of cash, and those deposits went into that bank. So that is the problem, because the banks have to make a profit on those deposits quickly. The problem they experienced is that they started purchasing these low yield bonds during the low rate times of the pandemic. Now the rates have gone up. Remember what happens to the value of bonds as the rates go up? Yep, exactly. Bond values come down. Over the last few years, it's been very difficult for banks to find high yields to cover these fixed interest expenses. Now, these private equity groups are telling their business partners to pull money out of the bank because of the solvency issues. So the banks have to sell these bonds at a discount in order to get the depositors' money back. Silicon Valley Bank, Silvergate Bank, Signature Bank, First Republic Bank, and a few more coming have been downgraded. The whole banking sector has been downgraded by Moody in its outlook for the banking system. And all of this is rapidly deteriorating. These banks are victims of their own success. They grew too fast with large amounts of deposits over a very little period of time. And they had to make drastic moves. They became too big to fail, and the government now has to step in to protect those that had no part in the gambling business of these banks. If you think about it, it really doesn't make sense. Most people are irrational and fear spreads quickly. But the bright side of all is that irrationality creates fear and fear creates opportunity. So where are these opportunities? And most importantly, where is the safest place to park my money during times of uncertainty? Are you diversified? Do you have all of your money sitting at the bank waiting for monthly interest the bank pays you to make you wealthy? You should diversify, and tangible assets are the best hedge during times like this. Real estate has outperformed inflationary markets over and over, and if you combine the bank runs going on, what's safer and better investment than an asset that you can touch, that you can use, that you can feel, and that will be there tomorrow? Unlike the value of your stocks, your bank account, or the value of your money being depleted with ever increasing inflation. Now, if you are a speculator in real estate and need to sell your houses immediately because you don't have any other exit strategies, you have to be very careful. We might have a small boost in mortgage applications since mortgage rates may start to fluctuate in the wake of SVB's collapse, but if the banking system problems continue, the bigger problem is a recession, and that would have an impact on the housing market. Keep your real estate portfolio balanced. For your equity appreciation properties, stick to affordable houses, where the marketability of these properties has the widest net. Invest in cash flow from rental properties or commercial properties with low loan to values that pay you a fixed monthly interest yield, and that also you can diversify into other markets to avoid having all of your eggs in one basket. The Federal Reserve is scheduled to meet any day now. How will they react during this crisis? Will they continue to raise interest rates, or will they stop? Are they in a catch-22 where they must choose between more interest rate hikes to stop inflation, but then run the risk of unrealized losses to be triggered that will cause a panic, and then the panic causes more bank runs? Will they keep interest rates as they are avoiding another panic and see if things fall under control? But then what about inflation? The cost of all things continues to increase. Monthly inflation is rising at double the rate that economists say is needed in order to bring inflation back to 2% that they're looking for. How will the rest of the banking system react? What is the Fed going to do in the face of this madness? The 4 biggest banks in the United States lost a combined $52 billion last week. Then more banks saw double-digit drops in their stock price. How many times have you seen fluctuations in the stock market destroy billions of dollars overnight with no underlying asset that you could keep to recuperate your losses over time? Even cash is at stake. What if you were one of those account holders in the Silicon Valley Bank with more than $250,000 in the bank? Would you count on the FDIC to come in to the rescue? Are we done with these bank runs? Or could we just be looking at the tip of the iceberg? Why don't you become the bank? Why don't you become the bank that is secured with an investment, a tangible asset, with a private mortgage that pays you a fixed yield, and that is secured with responsible leverage? We are HIS Capital, a family group of companies that specializes in real estate investments. We use our balanced investment approach to diversify our portfolio with multi-strategy investments. We invest in commercial and residential investments that produce cash flow today, but that also have built-in equity and appreciation for the future. We diversify our investments in different markets where our borrowers, tenants, and partners have the highest demand for affordable cash flow and equity. We believe in responsible leverage, helping our active borrowers invest in the most active real estate markets with solid collateral that is secured with a solid loan-to-value and other risk-mitigating pillars of make sense underwriting. And our passive investors are able to generate double-digit returns with secured first-position mortgages that they control. I am Roque with HIS Capital, and I hope you enjoyed this video.